Thank you and welcome you to this video overview of the investor letter that I wrote for the month of September. Let me share my screen. So I've termed this month's letter as "Dar ke aage jeet hai," and the reason is that as you're all aware, markets have not been good for the last 1 year. It's been uh, very topsy-turvy. The global news has been extremely negative. There has been consistent FII, FPI selling. The only saving grace in all of this has been the domestic buying that has happened. But overall, what with the US tariffs, with different wars, Operation Sindoor, things have not gone well in the last 12 months. And it is to an extent reflected in the indices. So this is a very good website that Edelweiss has, where they capture the different indices that are there. So as you can see here, let me maybe increase the size. So based on market cap, I think Nifty 50 total return index has been the only index which has been positive, and even this has been practically marginal. I mean, it's 0.1% in the last 1 year. Everything else, Nifty 500, Nifty mid cap, Nifty small cap, Nifty micro cap, everything has been down over the last 1 year. Interestingly, the smart beta strategies, the different indices, again, for the last 1 year, if you see, everything has been down. So whether it is the quality factor or the quality index, low volatility, Nifty 50 equal weight, uh, Nifty 200 momentum, mid cap momentum, small cap momentum. So you name it, Nifty 500 momentum, Nifty 500 multi cap momentum. So everything has been down in the last 1 year. Uh, and this is actually not something which is to be very concerned about. This is part of the investment journey. Like I keep saying, right, and I'll mention it once all over again at the end of this video, is the 1 in 4 rule that I have. 1 in 4 years we lose money, and probably this is the period in the last 1 year where everything has been down. There are two funds that I directly manage, Shree Lakshmi and Shree Vriddhi. Uh, Both of them have been struggling. Uh, Primarily, I am a growth oriented investor. People who've interacted with me, people who've heard or read what I write, you would always you would know that I am a very strong proponent of growth based investing, of momentum oriented investing, because over many cycles, over very long periods of time, these are the factors which have proven to be the most consistent and the most rewarding uh, in terms of wealth creation. There will be times when these strategies, growth will not work. There will be times when momentum will not work. But if you take a longer period of time, take 3 years, 5 years, 10 years, then these tend to give significantly better returns, higher quality returns than other, similar strategies. And when times are bad, right, we need to take small wins. We need to keep looking at the bright side. And after quite a while, after a period of months, I think the last time uh, Lakshmi and Vriddhi funds made it to the top 10 list was in the first half of 2024. I was, looking at the performance, and I found, to my surprise, that Shree Lakshmi is the 18th ranked fund in the last 1 month and the 15th rank in the last 3 months performance. This is across all mid cap, multi cap, flexi cap funds. There are about more than 300 odd funds that are there, and we are in the top 20 uh, in that. So that's something that I take a little bit of solace from, that at least what we are doing is on the right track. And as and when we see markets improving, people who those of you who track your portfolios, you would have seen that Sri Lakshmi has recovered over the last few months. It's been performing reasonably better than the last previous 6 months. uh, can't say the same for Shree Vriddhi, because momentum as a factor, again, I mean, it started picking up slightly, after April, but again, in the last month, I think was extremely bad for the entire market. Luckily for Vriddhi, we have made some changes to the strategy, and we've been able to reduce the downside. So last month we did not have too much of a downside. So what we've done is, anyway, we are very concentrated investors. I always believe that wealth creation happens only through concentration. You cannot have a portfolio of 50, 60 stocks to create significant wealth over long periods of time. It Wealth creation happens through concentration, and that's the reason why you find both Sri Lakshmi and Sri Vriddhi to be fairly concentrated. So in most portfolios that I run, in these two funds, it will be between 10 to 20 stocks. So in Vriddhi, we have now moved to from the typical 10 stocks that we have to slightly more number of stocks. So we have between 15, 16, 17 number of stocks, depending on uh, when we look at it. So the idea is to catch the short-term momentum as and when it plays out. But having slightly more number of stocks is giving us the advantage, or giving us the leeway to actually uh, be a slightly more patient in managing drawdowns. So we will probably slowly migrate to being fully concentrated once the market starts trending once more. Till such time, we will keep having a slightly more, slightly less concentrated. So, we may not have 8, 10 stocks or 12 stocks. We might have 15, 16, 18 stocks. Uh, so over the last 1 year, I think there are very interesting takeaways from this period. The first thing I think is to sort of reiterate both to ourselves and to everybody, is that there's no strategy that works all the time in the stock market. It's never going to be the case. So sometimes growth will work, sometimes momentum will work, sometimes value will work, sometimes quality will work. But there is never going to be a time, or there is never going to be one single strategy that will work all the time, right? So the kind of investing that we do, which is growth oriented, which is uh, growth, quality, momentum oriented, and a combination of all of these, uh, maybe around 75 to 80% of the time, it works very well. Last probably 8, 9 months, 1 year has been the other 20% of the time, or the 25% of the time, when it does not work. And we just have to sort of bear with it, and let these times pass. And once, as and when times change, I think we will get back onto the growth curve once more. The second very important thing is, instead of chasing one strategy, it is more prudent to have exposure to both Sri Lakshmi and Sri Vriddhi. So anyone who asks me personally before opening the account, I tell them that you put 50% of your money in Lakshmi and 50 in Vriddhi, so that over a longer period of time, you get a much smoother return curve, and that is more desirable Maybe at some time Lakshmi will do better. At other times, Vriddhi will do better. So people who have been with us for the last 3 years, you would have seen that probably 2 years out of the last three, Vriddhi had significantly outperformed Lakshmi. Over the last, say, 1 year, Lakshmi has been doing much better. So the point is that over longer periods, a combination of Lakshmi and Vriddhi tends to work well. Interestingly, what we are also seeing is that business cycles are getting much shorter, right? So previously, what we used to see is businesses doing extremely well for many years, sometimes decades. And now what is happening is probably because of so much of information being available so readily, communication has become so cheap, uh, efficiencies have come in through streamlined processes. So, you know, expansion. So somebody sees another company doing very well in a segment, uh, high growth, good margins. Uh, Case in point, say for example, Asian Paints, right? You have, you know, three other players jumping into that bandwagon because the growth and the margins are very, very lucrative. So then what happens is then you get a that very long cycle truncated with much more shorter cycles. So I think that is what is happening, and consequently, the stock performance cycles also have started getting shorter. So previously, what used to do well for 3 years or 5 years, that performance cycle is now reducing to shorter time scale. So it's now doing well for maybe a year and a half instead of 3 years to 5 years, and then we see that particular performance for the company in terms of profitability, revenue starting to dip, and consequently the stock price starts to come off or consolidate. So this is another thing that is happening, and we need to continuously keep adapting to these cycles for us to continuously perform well with our investments. The other very, very important thing which is happening, and especially today's day and age in the investing field, is that the access to information has become extremely, extremely good. Everybody today has access to AI and LLMs or ChatGPT, Perplexity, Gemini, Claude, and whatnot, right? So even people like Screener, every system is giving us annual report summaries, con call summaries. So people are able to cram much more into their day. But what I find is missing, and what I find is getting increasingly more and more difficult, is good judgment, right? And that, I think, is going to be the core of investing going forward, because actually just going through summaries of annual reports, going through summaries of con calls is not going to help an investor become better at judging the quality of the business, judging the longevity of the growth phase, judging how the business is going to perform over time. What are the lacunae in the business? How is it going to? What are the major risks? A summary, whether done by a human or by an AI, is ultimately somebody's, somebody else's point of view on what to reduce, right? Sometimes the tone of voice, sometimes the explanations, sometimes what goes back and forth between a questioner and the person who's answering. Those give out more subtle clues about, about a business, about a person, than what can be actually captured in a summary. So I think that is going to increasingly become a rare commodity, and that is where I think the skill and the judgment of an investor would come into play. On the same note, I think the biggest challenge today for an investor is to focus, is to block off the cacophony of daily breaking news in the news media. uh, Trump is tweeting something. There's Russia, Ukraine is saying something. India, there's political news every day. There's business news every day. Continuously, something or the other is happening. If you go on social media, whether it is Twitter or YouTube or Telegram, Instagram, whatever gram that you use, uh, everybody has some opinion on the stock that you hold, right? Somebody is buying, somebody is selling. So it's crazy out there, and to be able to block off that uh, deluge of news and deluge of opinion is very, very important, because you know, as an investor, my time frame, my risk appetite, my return expectation is not the same of that of the other people, who are flooding these social media. So why would I want to listen to them? So that is something that we try to actively do. Uh, and one of the ways we are trying to do this is to increasingly add more and more quantitative analysis to our investing. So, when I started in the year 2000, it was a completely, uh, you know, uh, value oriented, reading books, reading annual reports, numbers, going through balance sheets kind of investing. Over the years, I have incorporated various aspects, whether it is more of quantitative analysis, technical analysis, macro, all of that together. Now, I think has made me much better as an investor over the last decade, decade and a half than what I was before that. And increasingly, I am finding that quantitative analysis definitely gives an edge uh, over just plain and simple opinionated investing as such. So basically, what I'm trying to do is to combine uh, quantitative analysis with the judgment, the human judgment that we've built over the years in terms of analyzing businesses and industries. And in this whole process, we continue to keep learning, experimenting, working with our different processes, strategies, doing deep dives on industries, on sub industries, or on niche categories. Niche areas of business, and that's how we believe that over time we will be able to generate reasonably good returns for ourselves. And lastly, as I said, we always need to remember the 1 in 4 rule. And we have to keep reminding ourselves of this all the time, that 1 in 4 years will be bad, where we will lose money. 1 in 4 stocks will not play out the way we thought it would. 1 in 4 stocks we will get in or out too early or too late. Uh, the other thing that we have to remember is, once every year we will see a 10% fall in the markets. Once every 2-3 years we'll see a 20% fall, and once every 8-10 years we'll see a 30% fall. And like I said before, these timelines are getting shortened and shortened. So maybe, what we will see is that we are going to maybe see a 30% fall maybe every 5 years, right? So that is something that we have to prepare our minds for, if we have to survive and thrive in the equity market, because it is never going to go up in a linear direction, right? uh, I think the important part here is to remember why we are investing in equities, the goal, what is our objective. I think for me it is very clear. The objective is wealth creation over long periods of time, and we have to be steadfast in that. And if we remind ourselves that our journey is to compound our capital over time, then a lot of other things fall in place. Then we stop reacting to very short-term gyrations of up. Either if we don't get euphoric when the market goes up, and we don't feel despondent when the market goes down. That is, I think, the most crucial aspect that we need to remember ourselves. Like I say, when the going is good, we need to tell ourselves that there is going to be tough times ahead. Now, we've seen a year of tough times, and we need to tell ourselves, or need to keep in mind that there is going to be good times ahead. So let me conclude with this, with the title of this month's letter. Like I said, "Dar ke aage jeet hai." Thank you for listening.